All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world, and happy Friday, everybody. Today's August 9th, 2024. And the top story this morning, the AI Mania trade is not dead yet. I wish it was. I'm sick of hearing about it. I'm sick of seeing it. It makes no sense. It defies math. Companies don't make any money, and the world is starting to wise up to that. In the last couple of weeks, we've seen this whole slurry of articles and analyst notes pointing out the obvious. Hey, guys, these products are shit, and these companies don't make money. Why did we create a $15 trillion bubble around this garbage? Hey, the chatbots, they're neat, they're cool, but I wouldn't trust it. But hey, $15 trillion later, here we are. But you know, we got news this morning from Taiwan Semiconductor that says it's not over. It's not. Because look, while the AI companies don't make any money, while the products are garbage, the big tech companies are still spending tens of billions of dollars on data centers and equipment as if someday they won't suck as much. And as long as big tech keeps spending that money, Taiwan Semiconductor is going to keep building the chips. And we saw that today. Taiwan Semiconductor announced their July sales, and they are up big year over year, 45% sales growth at Taiwan Semiconductor, led by AI chips. So if Taiwan Semiconductor, who makes the chips, is seeing big bumps in sales, well, who do you think they're selling those chips to? Obviously, that is Nvidia and Nvidia's customers there. So I have every expectation that Nvidia is going to report another phenomenal quarter. It's backed by hot air, or should I say hot garbage, because these companies just burn money. The companies that are ultimately using these chips or renting these chips, they don't do anything useful with them. And pictures of people with melty, mushy faces and too many fingers and feet that turn into telephone receivers arbitrarily. Yeah, okay, there's $1 trillion company, but big tech is still spending the money. And we saw that with all of the big tech earnings, which were pretty meh. Some of them were okay. Most of them were lousy. None of them made any money on AI. Meta made a little bit of money off of advertising revenue, claiming that AI was driving it, but that's a claim that's dubious at best. None of them make any money with AI, but they're still spending tens of billions in CapEx. And it's that CapEx spend that is driving Taiwan Semiconductor sales, and that's driving Nvidia's sales. And so I think this silly AI mania still has legs. It may still run. Now, that's assuming that when Nvidia reports another remarkable quarter, that all these idiots continue to bid up its stock price. Maybe people are starting to wise up to the fact that it's a house of cards. Maybe not. Assuming AI investors suddenly start asking questions about what they're buying, that's not really a safe assumption. So I'm going to go with the assumption that they're going to keep doing the same stupid thing, which means Nvidia is probably looking at pretty good results here. And another example, if you really doubt me that AI Mania isn't dead yet, and again, I want it to be dead. I really do. Look at what happened to SoundHound yesterday. SoundHound, an AI company, they do AI voice recognition, text-to-speech, whatever. SoundHound reported a loss that was triple their revenue. All right. They took their revenues were $13 million. And they lost something like $38 million. All right. They're losing money at a rate triple they're bringing it in. But you know what? They managed to eke out a 20% share price gain yesterday off of that news, because they also announced that they're buying this other company, Amelia, that also doesn't make any money. But when a company that burns through cash buys another company that burns through cash, the stock goes up 20%. Is that how that works? Well, it is in the AI world. So again, guys, these two stories tells me that AI investors are going to keep aimlessly bidding up the valuation of these stocks, and that big tech is going to keep aimlessly pouring tens of billions into CapEx. And so this bubble may have longer to live, even though the market is wising up to it. Also going on this morning, or yesterday, we got news from Warner Brothers Discovery. They took a big $9.1 billion goodwill impairment charge. They are impairing the hell out of that goodwill over at Warner Brothers Discovery. Goodwill impairment charge is just basically when the companies say, look, these businesses or these intellectual properties that we keep on our books, they're not worth as much as we claim they used to be worth. And so we're taking this big one-time hit to our earnings, and we're calling it a goodwill impairment charge. Well, Warner Brothers Discovery took a $9.1 billion impairment charge against their TV networks yesterday because they've been very slow to do what the other TV networks have done, write down the value of these intellectual properties, because people are cutting the cord. TV stations are not worth what they used to be worth. This is not really news, but Warner Brothers was very slow to react there. So their stock got clobbered yesterday, down 9%. We also got more bad news in TV land. Paramount Global is laying off 15% of their workforce. That's another 2,000 jobs going up in smoke. It's the best economy ever, and the tight labor market and all that other BS that they keep telling us. Well, there's another anecdata about layoffs. Although Paramount Global reported earnings that beat expectations, revenue that missed, their stock is doing all right this morning. This market just loves layoffs. We also got an article in, I believe it was Bloomberg, maybe the Wall Street Journal, that says most economists agree that the Fed is going to reject these calls for jumbo rate cuts. Now, the rate cut language in the last week or so has been just beyond ridiculous, guys. Absurd. We had one bad day in the market on Monday, and all of these muckety mucks were like, we need 125 basis points of emergency rate cuts. My stock that's trading at 37 times sales is now only trading at 36 times sales. And we need to inflate away the currency and make poor people even poorer because I'm not allowed to lose money. That was the message from financial elites all week, crying, please, sir, may I have some more? Give me another rate cut. Inflate my stock bubble even more. Well, the economists are saying that's not happening. And that's kind of been my opinion also. Number one, rate cuts, emergency rate cuts would be a terrible idea. I did a video about that on, I think it was Monday. I did a video about that. The reason why we had such turmoil in the stock market this week was because of the unwind of the yen carry trade. And rate cuts here in the States lowers our interest rates and brings them closer to what the interest rates are in Japan, where they're raising interest rates. So emergency rate cuts would just make the problem worse because it would reduce the interest rate arbitrage opportunity between the U.S. and Japan. And so it would accelerate the unwind of the yen carry trade. It's something that's pretty freaking obvious to me, and yet all these muckety mucks on CNBC don't seem to understand that. So that's one reason I don't think we're going to get an emergency cut. And another reason why I don't think we'll get an emergency cut or a 50 basis point cut in September is because if the Fed goes right from higher for longer, right from doing nothing to a 50-point cut, that would be the Fed admitting that they made a mistake. That would further damage their credibility, which is already wishy-washy. They don't have any credibility with me, probably not with most of my wonderful melon heads here in the chat. But for some reason, some people still believe the Fed has this under control. After transitory and after soft landing, they still think they can do this. Well, if the Fed comes out and cuts by 50 basis points on the first try, that would be them by default admitting that they waited too long to cut. They'd be damaging their own credibility. So I don't think we're going to get a 50 basis point cut. They might start at 25 and then the following month go 50. But first, we're going to see 25. And it seems like most of the economists are agreeing on that one. Also, speaking of interest rates, we had another disastrous bond auction yesterday. The 30-year Treasury auction came out yesterday afternoon. Recall we were talking about a disastrous 10-year bond auction yesterday morning from 2 days ago. Well, we had the same thing, a 3.1 basis point tail in the 30-year Treasury auction yesterday. That means as the government was auctioning off this 30-year debt, they had to lower and lower and lower the price until enough bidders showed up to be able to sell everything that they were trying to borrow. And so a big tail on that 30-year auction following a big tail on that 10-year auction. Investors have very abruptly lost appetite for long-duration U.S. government debt. And that tells me people's inflation expectations are starting to rise. Everybody is looking at how consumers are already just clobbered by the inflation story and how it's still getting worse, even though inflation has come down and the academics are like, oh, yeah, we're close to our 2% target. Yay, the soft landing. And most people who live in the real world are saying, shut the hell up. I can't afford life. What are you talking about? Well, if the Fed goes and starts cutting interest rates again, if they start easing again, most people are going to say, oh, man, here we go again. Inflation is coming back. And so investors don't want to lock up their money for 10 years or 30 years. We're already starting to see that in these Treasury auctions. And last but not least, we got a story in the Wall Street Journal saying Americans are not going to theme parks. Disney, Six Flags, and Universal all reporting big-time declines in revenue at theme parks. See also earlier discussion, people are broke and they can't afford life. They sure as hell can't afford a trip to Disney World. Again, it's the best economy ever. What's wrong with you plebs? You guys don't understand how good you have it. The problem is just your bad vibes, right? Isn't that how this works? Why don't we shrink my big million of a head and let's see what is going on in this market this morning, shall we? Guys, don't forget the like button for the YouTube algorithm. It really helps me out. And subscribe if you're new here because we do this every day. So come and have your coffee with the Melon Heads as we go through the markets. And the markets are down this morning, just barely. We got the S&P 500s down about 10 points or 0.2% lower this morning after having a pretty good week. Outside of Monday morning, the market did all right this week. It's still negative for the week. We'll see how we close this afternoon. The Dow, meanwhile, down 42 points or 0.11% to the downside. And the NASDAQ is leading the way lower, down 69 points or 0.38% lower ahead of the opening bell. So we got all three indexes in the red this morning. We've got the dollar's pretty much treading water here, up 1 basis point, 103.22. No big swings in the Forex market at the moment. Looking over at the bond market, we've got lower yields this morning here. The 30-year Treasury is at 4.222. That's down 6.5 basis points. Remember, guys, yields heading lower is prices heading higher. So we do have people bidding up bonds a little bit this morning here. The 10 years at 3.934. That's down 6 points and change as well. The 2 years at 4.026. That's down almost 2 points. The 10-2 inversion is now 9 basis points. We saw that get as low as a fraction of 1 point this week, back up to 9. So looks like we're not going to get that uninversion just yet. And the 1 month is at 5.376. That one's up a couple of basis points this morning, back pretty much to where we were when we started the week. Also, shout out to James Lavish on X, who posts excellent updates on these treasury auctions. Here's that 30-year auction result that we were talking about. Thank you, James, for putting these out. This is excellent information, and not many people do a very good job covering treasury auctions. It's pretty obscure data points, so I highly recommend you guys follow this one. He's saying another day, another dismal treasury auction, this time in the 30-year, 3.1 basis point tail. That's the largest since November. Again, the tail is what the interest rate is on the bond when they begin the bidding, and then how much they need to lower the price during the auction in order to sell everything they're trying to sell. That raises the interest rate. The difference between those two interest rates is the tail. So a big tail means lower demand for these bonds, and we had a very big tail yesterday. Foreign bidders only took home 65%. The bid to cover ratio, 2.31. That's roughly in line with the last 30-year auction. And primary dealers had to take home 19%. Again, that's an indicator that the demand really wasn't there. This auction was even worse than yesterday's 10-year, he's saying. I don't know if it's worse than yesterday's 10-year. It looks pretty much identical. I guess the primary dealers took home a little bit more on the 30-year than the 10-year. Maybe that's why he's saying this was worse than the 10-year. But guys, 2 days in a row, two really bad auctions on the long end of the yield curve. This is showing reduced investor appetite for that long-term U.S. government debt. In my opinion, that is reflecting worries about inflation, with everybody talking about the Fed easing and the Bank of Japan backing off of their tightening cycle. We've had some very dovish central bank talk recently, and I think that's spooking bond investors here. Also, just want to stop by real quick at the reverse repo. We've been following this one for the last few days. Yesterday's reverse repo was up slightly to $303 billion. That's up from the $286 billion from the day before. So it's still within the noise in the chart, if you will. We're still trending down, but a little bit of a blip up yesterday for those who are watching the reverse repo. And on the commodities board here, we got a mixed bag. We've got spot gold is at $24.29. That's up about $3 this morning. We were just over 2,400 yesterday morning. So gold is looking all right here, up 0.1%. Spot silver here is at $27.49. Silver had a great day yesterday. We're back above that 27 handle here, although not doing so great this morning, down about a nickel or 0.16% lower. We've got September copper futures up 1.75%. October platinum futures down 0.75%. September palladium futures are up about 1/3 and September WTI crude oil is at $76.50. That's up about 31 cents or 0.4% higher. Also, Bitcoin had a really good day yesterday. We are back above 60,000. Big time buying going on in Bitcoin yesterday, although we're giving back some of those gains here this morning. Currently, $60,309 as priced on Coinbase. That's down about $1,392 from where we were yesterday. But again, a very good day yesterday, back above that psychological level of 60,000. And I just want to point out, shout out to Zero Hedge on X who put out this chart. This is showing the flows into and out of the Bitcoin ETFs. We have a big outflow from the GBTC yesterday here in blue, 182 million left that ETF. That has been going on since they got approved as a transition to an ETF. GBTC just charges way too much in fees. Money is constantly leaving that fund. But look at the inflows. We had almost 300 million almost 400 million in inflows yesterday into the others. So about 200 million net positive flows yesterday, led by, looks like the BlackRock ETF had the most. So that's probably why Bitcoin was up so much yesterday. And let's stop over at Japan real quick, because this has been on everybody's mind recently. The Nikkei had an okay day yesterday. It was up about 200 points, about 0.5%, although it did close off the highs of the day. The Japanese stock market has regained much of its losses from that bloodbath on Monday. And the Japanese yen is a little bit weaker this morning here. We are at 146.6. The yen is a little bit stronger here this morning. Again, when you see this chart moving down, that is the yen strengthening. I apologize for that. 146.6, that's down about 58 basis points against the dollar here. So slightly stronger yen. I don't think this really says anything about the yen carry trade. This is pretty much just normal price movement compared to that big sell-off that we've had over the last couple of weeks. This little bit of price action over the last 3 days, to me, that's just a dead cat bounce. And it probably says that we are looking at further declines in USD JPY on the horizon. Remember, guys, if everybody views the Fed rate cuts as inevitable, that is going to shrink the arbitrage between the Japanese and U.S. rates, which should speed up the unwind of the carry trade, although it's not going to happen all at once. And speaking of Fed rate cuts, Fed is seen rejecting calls for jumbo rate cut in economist survey. This one was in Bloomberg this morning. A large majority of economists surveyed see only a 0.25 point decrease in interest rates coming in September, and I agree with that assessment. A finding that's at odds with calls from some large Wall Street banks for a jumbo cut at the next meeting. They are so freaking greedy, aren't they? Nearly 4/5 of economists surveyed by Bloomberg predict the Fed will trim rates to a range of 5 to 5.25% at its September 17th meeting, with most of the rest predicting a larger reduction. The median forecast shows just 10% odds for a rare move to adjust rates prior to the scheduled gathering. Fed policymakers have pushed back on the need for aggressive actions following a weaker than expected jobs report in July, when hiring slowed markedly and the unemployment rate rose to the highest level in nearly 3 years. At the same time, Fed leaders led by Chair Jerome Powell have said they are putting increased weight on their full employment mandate while continuing to strive to reduce inflation to their 2% target. So they're saying here, look, jobs is more important than inflation at this point. They've kind of been drifting that way over the last few months. But I really think the Fed is looking at a 0.25 basis point cut here, because a 50 basis point cut would be admitting a mistake and further damaging their credibility. If you look at the CME Group's Fed Watch tool right now, only a 45.5% likelihood of a 25 basis point cut. Interest rate futures positioning still suggests the majority of people think we're getting a 50 basis point cut in September. I really don't think that's going to happen, but we'll see what we end up getting. Now on to the AI Mania trade, guys. I wish it wasn't so, but it sure looks like the AI Mania is going to live for at least a couple more weeks. This morning, we got data from Taiwan Semiconductor, the biggest chip manufacturer in the world. TSMC sales grow 45% in July on strong AI chip demand. Taiwan Semiconductor's revenue rose 45% in July, accelerating its pace of growth from the June quarter and bolstering hopes for sustained strong demand for AI chips from the likes of Nvidia. Sales for the month reached 256.9 billion Taiwan dollars. That's for the third quarter. Analysts had projected revenue would grow 37% to 747 billion, with the July results suggesting Taiwan Semi may surpass those expectations. Taiwan's biggest company is one of the key bellwethers for AI demand as the go-to chip maker for leading accelerator makers Nvidia and AMD. It's also the sole supplier of processors for Apple's iPhones. At a time the mobile device market is showing signs of bouncing off post-COVID era lows, last month the world's largest contract chip maker raised its full-year growth outlook to beyond the maximum mid-20% it had guided toward previously. Long story short here, guys, the people who actually manufacture the chips are showing strong sales growth. That means those NVIDIA orders are still flying in, and that probably means NVIDIA is going to report a really good quarter when they report on August 28th. We're still a couple of weeks out from that. Taiwan Semiconductor up 2.5% pre-market here, trading at $168.70. Pretty good day for Taiwan Semi. And in the most ridiculous AI story of the day, this one from yesterday, SoundHound sees losses outstrip revenue, though AI company beats on the top line. And look at some of the numbers in this thing. These AI investors will buy anything. It's like Ron Burgundy pronouncing the question mark on the teleprompter. Anything you say AI, these people will bid. Who put the question mark on that teleprompter? SoundHound AI saw GAAP losses swell in the latest quarter and continue to dwarf revenue, but top-line growth came in better than expected. The company, which makes software for conversational artificial intelligence, on Thursday posted a net loss of $37.3 million in the second quarter, equating to 11 cents a share. The net loss was greater than the $23.3 million figure seen in the year earlier period. So their net loss increased by 50% year over year. That's the net loss increased by 50%. Revenue for the latest quarter was $13.46 million. That's up 54% for the year before and ahead of the 13.1 million. So, oh, yay, our revenue grew 54%, but then again, so did our net loss. So what's the point of this company? They're losing even more money. And look at the numbers here, guys. They lost $37.3 million on revenue of $13.46 million. These guys will never turn a profit. They are nowhere near turning a profit. And we're talking about a point where AI, the funding for these investments may be going away pretty soon, because the only reason these guys have this money to burn is because somebody is giving them an obscene valuation. But you know what? That valuation, it actually went up, because earlier in the day, SoundHound announced the acquisition of Amelia, an enterprise AI software company, for $80 million. Oh, great. This company that loses money is buying another company that loses money. Sounds like time to buy the stock, apparently. Again, if you put that question mark on the teleprompter, he will read it. The business combination positions SoundHound AI as the foremost provider of voice and conversational generative AI with reach across multiple industries. So SoundHound loses money at triple the rate it comes in, but they're buying this other cash-burning company. What happens to the stock? It rallies 21%. They just announced a loss of $13 million on revenue of $37 million, and the stock rallies 21%. Tell me AI investors are not the dumbest things to cross the world of finance since, I don't know, the dot-coms, since sea monkeys. I don't know. What could possibly be dumber than this? This company is losing money at an accelerating rate, and yet they bid up the stock by 21%. Oh, they're buying Amelia. I have no idea what Amelia does, but they're buying it, and so I'm going to bid up the stock. AI Mania is not dead yet, guys. This just tells me it's got further to live. These people will bid up the stock price of anything. Taiwan Semi is still making money, still selling chips. So NVIDIA probably going to report another fantastic quarter. Changing gears a little bit here, Warner Brothers Discovery stock falls as it writes down $9.1 billion and misses estimates. That is a big goodwill impairment charge for Warner Brothers. Warner Brothers Discovery stock dropped Wednesday after it reported a $9.1 billion write-down on its TV networks and missed analyst estimates on revenue. The loss per share of 36 cents versus a loss of 22 cents expected, and revenue came in at $9.7 billion versus $10.7 billion expected. Warner Brothers Discovery on Wednesday reported the non-cash goodwill impairment charge, which was triggered by the reevaluation of the book value of its TV network segment. The book value was higher than the market value as traditional TV networks continue to see customers flee and advertisers are opting to spend on digital and streaming instead. I want to add total revenue for the quarter was down 6% to $9.7 billion. Total adjusted earnings before interest, taxes, depreciation, and amortization decreased 15% to $1.8 billion. So lousy results from Warner Brothers yesterday. That stock dropped 9%, 8.95% lower for Warner Brothers, trading at $7.02. And more bad news in TV land. Paramount Global announces it will cut 15% of U.S. workforce, but shares rise on second quarter earnings. This market just loves when people start cutting headcounts. And, well, the stock market continues to reward layoffs. Paramount Global is cutting 15% of its U.S. workforce, or about 2,000 jobs, part of a broader cost-cutting plan as it prepares for a merger with Skydance Media. Paramount has identified $500 million in cost savings, which include the headcount reductions as part of a $2 billion in synergies related to its transaction with Skydance. The job cuts, which will begin in the coming weeks and largely conclude by year-end, will target the company's marketing and communications departments and employees who work in finance, legal, and technology and other support functions, the company said during its earnings call. Here's how Paramount performed in the quarter. Earnings per share of 54 cents adjusted versus 12 cents expected. So we have an earnings beat, but revenue was a disappointment at $6.81 billion versus $7.21 billion expected. Second quarter revenue dropped 11% and missed analyst estimates as licensing, TV advertising, and cable subscription sales dropped. But all things considered, the stock is doing all right here this morning. It's actually up 3.92% at $10.61 a share. That's up 40 cents. My guess is the market is rewarding those layoffs and the cost cuts. Maybe that mild earnings beat is helping things here, although that revenue declining like that, very bad sign. Things just aren't that good in entertainment here, guys. And speaking of bad entertainment, look at this one. Americans are skipping theme parks this summer. Again, it's the best economy ever, and that's why nobody can afford to go on vacation, right? What's wrong with you guys and your bad vibes? Disney, Six Flags, and Universal owner reported softer results as consumers pull back or travel abroad. In the battle for American travelers, Mickey Mouse is losing out to Italy and inflation. Disney, Six Flags, and the owner of Universal theme parks each reported softer results from their amusement parks in the most recent quarters. The slowdown signals the travel surge that fueled higher attendance in theme parks after the pandemic may be waning following steep price increases and greater interest by travelers in other destinations. The lower income consumer is feeling a little bit of stress. The high income consumer is traveling internationally a bit more, Disney CFO Hugh Johnson said in the company's earnings call on Wednesday. In its most recent quarter, Comcast, which owns Universal Destinations and Experiences, reported a 10.6% decline in revenue in its theme park division for the previous year. Six Flags said its attendance declined 2%, which was partly due to fewer operating days than the year-ago quarter. Yeah, there's that calendar-driven thing again. Disney said its attendance was stable, though operating income in its domestic park division declined 6%. The results come as a range of businesses from McDonald's to Airbnb have reported softening demand, putting investors on high alert for signs of an economic slowdown. Look, guys, people aren't eating out. They're not staying at Airbnb. They're not flying. They're not going to theme parks. Retail is reporting lower same-store sales across the board. The economy is slowing. I don't care what government spending is doing or how many bombs we're sending over to kill people in Ukraine. That's not economic growth. That's not economic prosperity. The economy is shrinking, and that is painfully obvious to anybody who's paying attention, who isn't a political hack that just gaslights Americans because they're hoping to land a job in the cabinet that might one day give them some speaking fees. Shout out to Claudia Sahm. The economy is slowing any which way you look at it, guys. And I just want to say thank you so much to Larry Sullivan. Welcome to the Melonheads, Mr. Sullivan. Thank you so much for becoming a YouTube member. I appreciate the support of the channel. And thank you to M&J, who gifted 10 Nobody Special Finance memberships. Guys, if you receive one of those gifts from M&J, please say thank you in the comments. That was very nice of you, M&J. Thank you for everything you do for the channel, both in supporting the channel and your services as a Blue Wrench. Thank you for keeping things neat and tidy in the chat. And my man, Uncle Fedster, says, happy Friday, Jack. NSF is definitely my favorite finance channel. Mine too, Uncle Fedster. And I watch a lot of them. Well, I am very pleased to be included among that list, and I'm honored to be your favorite, sir. I shall strive to deserve that label. Thank you very much for supporting the channel, for everything you do as well. And T.A. Chapman is saying tinfoil AI. Hold on. Merchandising opportunity. Here we go, guys. Product placement. The tinfoil hat has been donned. Tinfoil AI, the chat AI bot, is hilarious. Economy, Mickey Mouse, bananas. Happy Friday, everyone. Don't forget to glue your pizza together. That's right. Google AI said using a little bit of non-toxic Elmer's glue in your pizza sauce is a great way to keep this cheese from falling off of your pizza. Shout out to the F. Smith on Reddit who came up with that 11 years ago, and then Google AI spit it out as if it was fact. It also said, hey, if you're feeling down in the dumps, jumping off the Golden Gate Bridge is a way to deal with that. I don't advise that outcome. That was Google's Gemini. And it also said eating at least one rock a day is recommended by most geologists. AI hallucinations are all over the place, guys. It is obvious that these products are not the groundbreaking breakthroughs that they promised us, but people continue to bid them up by the billions. That SoundHound result was just ridiculous. Tripling their losses, triple their revenue. Oh, but they're buying this other money-losing company, and so the stock rallies 20%. Again, who put that question mark on the teleprompter? These guys will bid up anything that says AI. Thank you so much, TA, for the support of the channel and for the merchandising opportunity. Appreciate that very much. And thank you so much to Estefano Azeas. Did I say that right, Estefano? He says, do you see AI mania the same as internet mania of 98, or will it just fizzle away? I think it is the same and worse. All right, I want you to, Stefano, there's a famous quote out there called, "What were you thinking?" by the former CEO of Sun Microsystems, who was trading at 10 times sales during the dot-com bubble. It's a very long-winded quote, but he basically says, look, for what you're paying for my stock, I would have to give you every dollar my company takes in revenue for the next 10 years without paying any payroll, any taxes, any cost of goods sold, the electric, my rent, anything. If I give you every dollar I take in, it'll still take 10 years to pay you back for what you're bidding up this stock to. And then he said, what were you thinking? That was Sun Microsystems at 10 times sales. Right now, Nvidia is trading at 32 times sales. So the AI mania, in my opinion, is 3 times as bad as the dot-com bubble was. 3 times as bad. And on a nominal basis, the AI mania has added $15 trillion in value to the market cap of the S&P 500. It is the biggest stock market bubble in history. And bubbles don't gradually coast down. Not ever. Bubbles pop. They burst and they fall off a cliff. So, no, I don't think it will fizzle away. I do think it will be a sudden, violent burst that takes place probably over a couple of months, maybe, not spread out over a year, year and a half. That being said, I don't think it's going to happen anytime soon. I don't think it's going to happen in the next few weeks because NVIDIA's earnings are probably going to be awesome. And based on investor behavior around that SoundHound story, I have every reason to believe NVIDIA is going to do very well when they report on August 28th. I'd love to be wrong about that because that would prove me right about everything else. But I think NVIDIA is probably going to do pretty well here. Thank you very much, Stefano. And thank you to Steve Woitas. Excuse me, Steve, still fighting a sore throat. He says, if the yen carry trade unwinds, where's the next source of liquidity going to come from to further inflate the market bubble? Come on, Steve. I think you know where it's going to come from. Where do you think that liquidity is going to come from? I will give you one guess. That's right. Oh yeah. Don't you look away from me, J-Pal. Look me in the eye when I'm talking to you. We know it's going to be you, J-Pal. Jerome, we know you're going to print. We know you're going to Zerpenber, and your boss is going to make you. She's going to say, Jerome, I'm going to need you to spin up that money printer ASAP because we've got the stock market is falling right now because there's a liquidity crisis, and we can't have that happen on my watch because I'm a political operative. So I'm going to need you to go ahead and spin up those money printers and monetize my debt, even though history shows that's a catastrophic outcome for the average person. When we do that, I don't care. I'm just trying to collect speaking fees in retirement. Well, thank you for that unusual bit of honesty, Secretary Yellen and Jerome Powell. That is where the liquidity is going to come from, Steve. And based on how fast the Fed rolled over with the Bank Term Funding Program back in March last year when the bank crisis was happening, and based on how quickly everybody was begging for emergency rate cuts this week, and how quickly the Bank of Japan backed off of their tightening cycle when things started to go awry on Monday morning, I have every reason to believe the central banks will give the markets exactly what they want, which means they will inflate. It's just a matter of when. Thank you very much, Steve, for the super chat, sir. And Larry Sullivan is back. He says, oh, Larry, the new Melonhead member. Welcome again, Larry. Thank you, sir, for the super chat. He says, not currently investing, but wanted to learn as much as I could before I start. You are doing it right. Abso-freaking-lutely. Before you start throwing money around, do your research, read, trade on paper, and see how your trades go before you throw real money. Excellent job, Larry. Much respect for the channel and community. Happy Friday, Melonheads. You are very welcome, Larry. Thank you so much, sir, for the super chat, for the support of the channel and the kind words. And I think you're doing it right. Keep learning, buddy. I think you'll do just fine. And welcome to the Melonheads, sir. And welcome, Eric is a new member. Hello, Eric. Thank you for joining the Melon Heads as well. And I hope you enjoy your stay. Thank you so much for supporting the channel. And Raymond, the thoughts and minds. Thank you so much, Raymond. He says, remember in 2008, the housing crash of 30% took 3 years, and the crap job market lasted almost a decade. I graduated in 2011 and was in my 30s before I was net positive. You know what? I took a bath in the 2008 market crash as well. I paid my mortgage the whole time while zombie homeowners were rewarded. They were able to stay in their house for 7-8 years without paying anything until the banks finally got around to foreclosing on them. Joke's on me. Look, the crash of 2008 never really ran its course, Raymond. They spun up the money printers and they QE'd and they zerped their way out of it. Excuse me. But the underlying rot, the over-financialization, the moral hazard of risk-taking on Wall Street, that problem has only gotten worse since 2008. So, you know, for considering the fact that everybody's like, yeah, they're just going to print again and they're just going to lower to get out of the problem, they probably will do that. But let's also consider that every crisis, every time they have to intervene, the intervention has to get bigger and bigger. And now the interventions have gotten so big that we're starting to reap the whirlwind, i.e. inflation, because of that. So, you know, fighting this war with the weapons of the prior war is rarely a good idea, and it usually doesn't end well. And the Fed, they approach every crisis the same. Let's shovel liquidity into the system and let's lower interest rates. That may not work this time around because of the inflation problem. And I think that's why we're starting to see these lousy auctions in the 10 and the 30 year. So it may not work this time. That's the one thing I would point out. Thank you very much, Raymond, for the super chat and the support of the channel and for sharing your experience with us. And Grandpa, thank you so much, Grandpa, for the super chat. It says Treasury has the power. The Fed just follows the 2-year. Yep. And I would add Congress to that as well, Grumps. I think Congress's total abdication of the power of the purse has allowed the Treasury to just pour Treasury bonds onto the market, borrowing. And the Fed has accommodated and enabled both of them through the monetization of that debt. And even though they're telling us they've raised rates and they've been doing quantitative tightening, they've actually been injecting more liquidity into the long end of the yield curve. Shout out to my buddy Joe Brown, who brought that up in our interview last week. Check that one out, by the way, if you haven't seen it. That was pretty good. Joe Brown, one of the best out there in financial YouTube. Larry, that's a good one for you to follow as well. Since you're new here, check out my buddy Joe Brown over at Heresy Financial. He is one of the best in the business as well. And thank you so much, Grandpa, for supporting the channel. And thank you to all the Melon Heads for having your coffee with us this morning. I appreciate that very much. Thank you so much, guys, for the generosity in the super chats. And to all my Melon Heads and magnanimous Melon Heads on YouTube, thank you guys for supporting the channel. Links down below to all that good stuff, should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. I'll be back at 3:15 p.m. Eastern Time today for our weekly wrap-up live stream. So I'll see you guys in just a few hours. Until next time, live small and dream big. Salud.